Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lovisha, Darad. And of course, the markets, they have clearly recovered after we did see a broad-based sell-off on the day of the budget, which was yesterday. If you look at Sensex, that's soaring with about 900 points gain, 1% gains coming in for the Sensex also. Nifty also soaring, and it has reclaimed that to 25,000 levels itself. So yes, both the benchmark index have been, soaring in the trade with about 1% gains. But yes, if you look at the market breadth, that has clearly, turned quite positive. 1:2, that's the advanced decline ratio. Slowly, we are seeing 1:3 also, which would be seeing at this point of time. But yes, if you look at from the sectoral front, majority of them have seen a buying interest today, particularly for the Nifty Auto Index, which is seeing a gain of about nearly about 2% itself. On the other hand, majority of the sectoral indices, be it your Bank Nifty Index, showcasing a gain of about 0.3%. Nifty FMCG also soaring in the trade. Nifty infrastructure on the back of the budgets. Capex push is seeing a bit of a buying interest today. Metal index is also seeing a bit of a pullback today, given that we have seen that the metal index has seen quite a deeper correction, not on just yesterday, but of course on Friday also we did see that the Nifty metal index had seen a sharper bit of a correction. Today it's seeing a bit of a pullback, nearly 2% gains coming in from the Nifty metal index too. Nifty realty also seems to be doing well, but yes, the pain in the pocket comes from the Nifty IT index, seeing 0.5% decline, and even Nifty media index showcasing a decline of about 0.1%. But yes, the broader end of the markets have staged a recovery. If you look at Nifty small cap index, 0.5% gains coming in from there. Nifty mid cap also showcasing a gain of about nearly 1% too. So yes, the pain which was visible in the broader end of the markets have also staged a recovery as of now. But yesterday markets, they were perturbed by the STT hike on derivatives. But today definitely seems out to be a better day, given that investors have digested the news, seeing that the STT hike just a temporary hit, just a sentimental reaction. And even the majority of the market experts throughout the day that we have spoken to, they have codified this as a fiscally prudent budget. And given that apart from the STT hike, there has been good allocation to the emerging new themes. But yes, so we'll be understanding throughout the show how the budget means, what lies ahead for the markets. For now, the top gainers on the Nifty 50 looks like Power Grid soaring in the trade with about 7% gains, Tata Motors passenger vehicles with about 5% gains, Adani Ports doing well with about 4% gains, Reliance Industries with about 3% gains. And on the flip side, on the Nifty 50's losers front, you can see Shriram Finance tanking in the trade with about 3.5% cut, Axis Bank also losing in the trade with about 2% cut, Max Healthcare with about 18 points decline, a 1.5% cut coming in from there too. Infosys, Cipla and Titan seem to be the other Nifty 50 losers as well. But yes, to understand the last minutes of the trade and how you should be positioned, I'll quickly go across to my technical expert of the show. Joining me is Ajit Mishra of Religare Broking to understand how the markets look like. Ajit, good afternoon. And Nifty clearly staging a recovery, reclaiming that 25,000 levels. What do you make of the sentiment? And of course, yesterday we did see a dampening of the sentiment on the back of the STT hike news. But do you think that the markets have already priced in that correction?
Yeah, good afternoon, Lovisha. So, Lovisha, yes, it's an important, day of recovery, considering that, markets were anticipating that yesterday being a special session on the Sunday, there could be a rub-off in the following session also, when the FI also resumed the trend. But it turned out to be otherwise, means we are seeing that market is witnessing recovery and we are inching closer to the day's high. So in case if we manage to hold these areas and, yesterday it was a decisive, breakdown below the long-term averages of 25,150. And that's why we saw this sharp decline around 24,600 before ending around 24,800 mark. So in case if we manage to reclaim those levels again, what we breached on the budget day, probably we are out of woods, means at least we'll not be seeing this kind of volatile swings every now and then there'll be more of time-wise correction that the market is going to experience. Otherwise, possibility of profit taking resuming again seems high. So as of now, it's a kind of wait and watch market, wherein we should see whether we manage to reclaim 25,150, the 200 days of exponential moving average or not. In the interim, stock specific, theme specific, there are ample opportunities on both sides of the market. Focus, should be accordingly.
All right, that's the view, Ajit. But yes, Nifty PSU Bank, that continues to be one of the top sectoral losers today. We're seeing a bit of a profit booking. What does the chart indicate going ahead? Because in the past couple of sessions, we've seen that the PSU banking index has declined by about 8%.
True. So post budget, we saw a very sharp cut. Basis the anticipation that there could be treasury losses to the PSUs post this possibilities of higher borrowings. So, but anyways, we were seeing very strong trend unfolding in the past for most of the PSUs. So, market was anyways looking for some reason or the other to correct, especially in the PSUs and metal, and that is what we are seeing right now. But at the same time, yes, one should not get carried away that since the trend is up, one should look for buying opportunity on every day. Let them stabilize a bit. Means some of these PSUs, they have done exceptionally well in the recent month. So after this recent dip, there could be a bit of a consolidation. So stock like SBI, Indian Bank, Canara Bank, Bank of Baroda, the more outperformers within the PSU is something that you can consider.
Okay, all right. That's the word for PSU banks. Right now, the PSU banking index has definitely staged quite a bit of a recovery from the day's low. 78 points uptick coming in for the index and nearly a percent gains for the PSU banking. But yes, let's talk about Nifty IT index showcasing a bit of a negative downtrend with about a 0.4% decline. And of course, in the past couple of sessions also, we have seen that Nifty IT index has been one of the top laggards. Ajit, coming to you for the IT index, of course, we're seeing a bit of a decline today, but does the near-term sentiment hold positive?
In fact, I feel that, Lovisha, it's a kind of a base formation which is going on in some of these IT majors after this recent phase of recovery. So definitely it's a good sign until we see a similar kind of move that we are seeing in the other sectors, volatile swings. So as of now, it is okay, and they might continue to trade with sideways bias in the near future. But stocks like HCL Tech Mahindra, Infosys, these are some of the names which one should keep on their radar and look for accumulating them on dips, with a short to medium term outlook.
Okay, all right. Let's talk about defense stocks. They've been under pressure today. It's trying to stage a recovery from the day's low, but if you look like the charts of Hindustan Aeronautics, BDL, that's seeing a significant decline of about 4%. If you look at Bharat Dynamics stock, definitely it's trying to make a recovery from the day's low with about 4% gains, but still down by about 4% as of now. Despite the higher allocation, Ajit, it looks like defense stocks are completely unimpressed with the budget focus. What do you expect? What lies ahead? And of course, at these current valuations, does it warrant a check for the investors?
So that's true. Means there was definitely a reference to defense budget part allocation also increasing, but market was hoping, I guess, for a bigger number considering the overall geopolitical landscape that we are currently in. Uh, but I still feel that some of these counters, no doubt, they are highly valued, in terms of the valuation. But at the same time, the visibility to the earnings is definitely there, considering the order book that they mostly counters have. Among the top names, HAL, BEL, that top list. In fact, BEL posted very strong numbers, and post that we are seeing this correction. So I feel that this dip is basically a buying opportunity, but not for very short term. Means short term it might continue to trade volatile. So in case if we have used, let's say, for a month or two, definitely you can start accumulating at current levels. Add more in case if it sees any dip around 420. For the entire position, your stop should be at 400, and positionally 470 to 490 is something that you can maintain as a target.
Okay, all right. That's the view coming in from the defense basket. But yes, since we're talking about the capital goods companies, well, let's also talk about railway stocks. They appear to be mixed in today's trading session, the likes of RVNL, Jupiter Wagons, Ircon International. And in yesterday, we did see that the Indian Railways got in a capex allocation of about 2.93 lakh crores itself. But still, the sentiment remains a bit subdued and sideways at this point of time. Ajit, what's to you for any railway stocks? Are you still finding them expensive at the current price point?
See, the challenge is more about execution, Lavisha, because we all know that the kind of order books that most of these companies have, and it's been almost a year now that the corrective trend has been continuing, and even post the budget, we fail to see any kind of positive reaction. So it's natural. Usually, we see something before the budget, and usually the rally phased out the moment we reached to the event. So as of now, in fact, in this recent month, we didn't see any traction on that part also, the pre-budget rally or something. So this shows that majority of the counters might continue to trade lackluster in the coming weeks. So if the view is very short term, the prudent approach is stick exit to those counters and switch to these spaces wherein we are seeing sustenance or positive trends. So stock or sectors like banking, some of the energy counters selectively in the FMCG space, and select counters from the auto space also something that you can consider.
Okay, consumption space is something that you're betting on also. But let's talk about tobacco stocks. Clearly, they have been showing a mixed trend. If you look at Godfrey Phillips, VST Industries, clearly showing a little bit of a weakness, especially that's coming in from Godfrey Phillips with about, the stock is down quite sharply today, but ITC has staged a recovery in comparison. I mean, of course, today we have seen that the new tax regime on tobacco products have also come into effect, which is why we are seeing a bit of a sentiment hamper on all of these counters. But yes, what do you expect? How do these charts hold for the near-term perspective? Can we see a further fall ahead?
So most of these counters, yes, they are gradually drifting lower. ITC was anyways reeling under tremendous pressure. Means from 400 to 300, it was almost a vertical decline. Now we are seeing a bit of stability in today's session. But it's too early to say that it's completely out of woods considering the overall trend. And same hold true for Godfrey Philip also, wherein we are seeing that the stock is gradually inching towards its long-term averages on the weekly chart. So daily we are anyways trading well below, in fact, the entire all the key moving averages. So around 1600 is something that the stock might find support. So it's too early to take any position. So in line with what we were talking about railways, this space is something also that you can avoid for a time being now if the view is short term.
Okay, all right. That's the view for tobacco stocks, avoid for the time being. All right, let's move on and talk about the metal counters. Of course, the sector itself has been clearly in focus, given that we the last 2 days have seen quite a deeper bit of a correction for the metal basket itself. But yes, we have seen a stellar run-up in the past couple of months itself, which is why we saw that in the past 2 days, both of these counters nearly saw about 5% fall. But yes, coming to you, Ajit, for metal basket, how do you view? I mean, is this just a start of a deeper correction? Because today, clearly, we have seen a pullback of about nearly 300 points from the day's low level.
So metal, Lovisha, they are highly volatile. We all know that the kind of move usually we see, they are high beta in nature and cyclical in nature. And after this sharp decline, we are seeing a bit of a stability. But again, one should not get carried away, especially in the metal space, considering that the volatility is likely to remain high after this sharp decline. But at the same time, some of these stocks in the ferrous basket, wherein we are seeing strength, was JSW Steel, Jindal Steel, Tata Steel. These are the names that we have discussed earlier also, wherein we see at least the downside seems capped. So in case if there will be any further correction, the kind of pain that we are seeing in Hind Copper, Hind Zinc in the last 2-3 trading sessions, so that not might be the case for those names. So in case if you are considering metal in the space, then prefer the steel counters instead of the other names.
Okay, all right. You prefer the steel counters over the non-ferrous ones then. All right, Ajit, what about the Nifty infrastructure? I mean, clearly the index has been one of the top sectoral gainers, and L&T has been driving the gains. Of course, we did see yesterday a big capex push, especially to the infrastructure spending, which is why majority of the capital goods companies have been doing well. But going ahead, do you believe that these are the stocks to bet on after the budget announcement?
So L&T for sure, because we are very close to the record highs. When it comes to the L&T price move, and rest of the counters they are slightly sluggish, means extremely volatile. Some of these stocks they didn't participate at all in the recent rally, so the underperformance is definitely continue to weigh on the sentiments. Irrespective of the positive announcement for the sector in the infra budget. So I feel L&D is the best bet that one can look at, considering its overall outperformance and the potential to inch towards the newer highs in the coming weeks. So with let's say around 3,800, 3,700 as a support zone, one can start accumulating even at current levels for the newer target or newer highs of around 4,200 plus zone.
Okay, all right. That's the view for LNT. But yes, let's talk more about some stock-specific reactions. If you look at Nestle, that is definitely doing well in today's trading session with about 2.5% gains. And we did see that the FMCG major had reported its Q3 numbers on Friday itself. Now, for the December quarter, we did see that the profit surged by about 45% on a year-on-year basis and to about 998 crore rupees, which is why the stock has been doing well. And majority of the brokerages have also remained quite bullish on the counter following its third quarter results, which is what the stock has been displaying at this point of time. But yes, the stock has been doing quite well. It's oscillating around its upper band itself. Ajit, the stock has been oscillating with about 1200 to 1300 band. What can we expect next in terms of levels?
So Lovisha, in fact, if you see the FMCG basket has underperformed, big time, in terms of the overall returns in the recent rallies, and but some of these stocks like Britannia, Nestle, Marico, they are among the flag bearers for the FMCG index. Means they have not only participated, but in fact they are set to retest their record highs. So Nestle also, comes across as a potential outperformer within the FMCG space in the months to come. And in case if somebody is planning any fresh position, so with stop at 1210, one can start accumulating even at current levels, and a decisive break above 1350 would trigger the next leg of the up move in the stock, so which can help the stock to reach about 1500 plus zone as well. So yes, this outperformance is likely to continue. You can continue to accumulate on dips with 1200 as a stop loss.
All right, 1200 is a stop loss for Nestle India. But yes, let's talk about another stock in focus. That's your Mahindra Life. The company has reported results, as a result of which we can see the stock has seen a good breakout today, 3% gains coming in for the counter itself. But yes, on the numbers front, it's a healthy, third quarter results. If you look at the residential pre-sales, that has seen a significant jump to about 572 crore rupees from 334 crore rupees. Even the consolidated profit has seen, the company has swung back to profit from a loss of the last year itself, which is why we are seeing a strong reaction in the stock price also. And the net debt to equity ratio of 0.12 levels also indicates a cash surplus position for this counter itself. But it's a good breakout for the counter today, 3.5% gains. Ajit, for Mahindra Life, how does this chart structure look like for the near term?
So it seems like a recovery, Lovisha, because from 660 to around 280 something, the stock has experienced a decline in the recent past, and now in the last couple of months we are seeing gradual recovery. Volumes were subdued at least. Now we are seeing at least some uptick in the volumes, and the stock is attempting to cross its major hurdle around 380-85 levels also. So that is encouraging, but at the same time, one should be slightly cautious because we are very close to the strong hurdle area, close to around 410 to 420. So if the view is very short term, one should not attempt a fresh buy at current level. In case if you have existing position, you can continue to stay put with 365 as a stop loss, and around 400, 410, you can look to book profits.
Okay, all right. That's the view coming in for this particular counter. That's your Mahindra Life. The stock is trading quite well today with about 3.5, nearly to 4% gains at this point of time. But yes, let's talk about BSC Angel One because these counters did see a little bit of a sell-off today after the budget's STT hike on FNO. But right now the stocks have recovered from the Sunday's sell-off that we saw yesterday. Ajit, how do we play all of these capital market counters, BSC, Grow, Angel One? How do they look like on the charts going ahead?
So BSC definitely has recovered very strongly after yesterday's decline, and in fact, if you see that the stock has been trading very close to its record high, so that anyway shows its outperformance. We feel that this consolidation or correction that we are currently seeing is more of time wise instead of price wise. Means until unless we decisively break, let's say 2550 on the closing basis for a day or two, then probably the trend might reverse. So otherwise, you can continue to stay put and in fact look for buying opportunity on every dips. Like what I've shared about 2880, 2900 being the hurdle area. So in case if we manage to cross this, then probably 3200 plus something that the stock might attempt. So one can definitely look for accumulation on dips when it comes to BSC. Angel One is likely to remain in a range in the near future. So 2150 to 2700, that's the broader range. We have retested the lower band of late, and a consolidation or recovery is likely, but there could be a very gradual move, in Angel One. So in comparison to like in a BSC, Angel One looks slightly sluggish in the near future. So if the view is prefer BSC.
Okay, all right. That's the view for all of these counters, and we'll watch out how these stocks behave in the upcoming sessions. But let's then 20 seconds to go before we get to the close. But let's talk about Power Grid, one of the top Nifty gainers today, definitely reacting well to its third quarter results, and of course the management raising its capex guidance for FY26, which is why we are seeing the stock trading at days high level. For you, Ajit, how does Power Grid look like?
So it's been almost like 1.5 years, Lovisha, that we are seeing this correction continuing. Though it's more of time wise after the initial correction from 340 to 40. Now we feel that this correction is likely to get over soon, and probably the stock will resume the uptrend in the coming weeks. So one can definitely look to start accumulating even at current levels after this sharp surge of roughly around 7.5%. And there could be a leg of fresh momentum in the near future also the moment we cross 275. So in any case, very short term, medium term, you can definitely look to accumulate this stock.
Okay, all right. Time to accumulate Power Grid. But yes, the last trades which is coming on your screen, Nifty 50 is back above that 2550 mark, so to say, 1% gains, and of course 250 points gain coming in for the benchmark index. Sensex also seeing a gain of about 900 points, 1% gain coming in for the benchmark index. And if you look at the broader end of the markets, the Nifty mid cap index and of course the small cap index is also back in the green with about a percent gain. So yes, in the last 30 minutes or so, the markets have definitely picked on the momentum, and right now it's ending with about good set of gains, snapping the 2-day losing streak that we did see in the past 2 days. But yes, the Bank Nifty is also doing well with about 0.2% gains. That is what it has settled with. The only pockets of pain that we have seen today is your Nifty IT index with about 0.5% cut. Nifty private banks have also settled in the green, flat but with a positive negative bias. But everything in the markets looks like quite good today. If you look at Nifty Auto Index, it is one of the top sectoral gainers. Nifty Metal Index has also done well. It has recovered from the past 2-day losses. It's pulled back into the green with about 2% gains. PSU Banks has also settled green with about 0.8% gains. Nifty Realty Index seems to be, it has done well with about 1.5% gains coming in from there as well. But yes, let's take a check of the volatility index. India Wix clearly cooled off with about 8% decline. So showcasing that once the budget is over, there's a little bit of an uncertainty which is over for the markets, which it has been quickly anticipating in the run-up of the budget too. But yes, let's take a quick check of the Nifty 50 gainers and losers of how do we stack up on the large caps front. If you look at the advanced decline, 39 stocks have advanced for the Nifty 50, while just 11 stocks have declined for the Nifty 50 gainers list. Power Grid, as we were discussing about with Ajit on the back of its Q3 results and the management raising its capex guidance for FY26, and which is why the stock has settled with about 7.5% gains. But yes, other than that, Tata Motors passenger vehicles also soared in the trade with about 5% gains. Adani Ports, Bharat Electronics, Tata Consumers, Reliance Industries contributing to the Nifty's up move today. L&T also soaring in the trade. Mahindra and Mahindra, Adani Enterprises, all of them did quite well today. But yes, on the contrast picture, what did not do well, that looks like Shriram Finance. That saw a decline of about 3%. Axis Bank also losing in the trade with about 2% decline. Max Health, Infosys, TCS, Cipla, Apollo Hospitals, Bajaj Auto, some of the other losers on the Nifty 50. But yes, coming back to you, Ajit, for your top picks, anything that you are liking in the market after now that the Q3 results is almost towards the end also, and of course the budget uncertainty also is over?
Certainly, Lovisha, considering that there was extreme volatility and which is still continuing, OMC basket definitely looks more promising, considering that there was hardly any participation on the downside during this recent decline. In fact, we are seeing strong recovery in today's session for BSC specifically, means the stock is inching towards record high. So we feel it's a good opportunity to accumulate quality names from the OMC basket. So with stop of let's say around 355, one can go long in BSC even at current levels. and 385, 390 position is something that you can maintain as a target. At the same time, one should not go overboard, considering that we are very close to the immediate resistance of 25, 150 and the index. Auto counters also, I believe that they are comparatively better. Means after this correction, we are seeing that the auto numbers were also good. So from the ancillary space where we see less volatility, that is Samvardhana Motherson, after this recent correction, the stock is consolidating around its major averages. So downside seems capped with stop at 108. One can accumulate some Samvardhana Motherson at current levels with 126 as a positional target.
Okay, all right. Those are the stocks that we need to watch out for. But yes, sir, with that, we have to let you go, Ajit. And thank you so much for your time and joining us.
Thank you. Thank you.
All right, clearly, it's a good day after the budget sell-off that we saw yesterday. Nifty has reclaimed that 25,000 mark. And if you look at from 240 onwards, the markets have been on a steady rise. So yes, if you look at the Nifty 50 index from the day's low level itself, the index has recovered up by about 400 points. So yes, it's a good day for the markets. And we'll watch out how the next couple of sessions look like for the benchmark index in terms of levels and whether or not it can inch towards that 25,100 mark. But yes, before we move on to our next guest of the show to talk about markets and the ways ahead, let's quickly dive into a conversation by my colleague N. Mahalakshmi, where she spoke to market veteran Neelkant Mishra to understand where the rupee is headed from here on after it did depreciate over 6% last year. Tune into this conversation.
The second one could be temporary. The first one is slightly more structural. So let's see when that happens. But frankly, in all of this, I don't see what role capital gains taxes have to play. The rupee is not behaving in a manner which requires emergency medicine. So clearly, this is a much harder global financial environment. 10-year yields in the US are at 4.25, despite all the expectation of the 50 basis points of cuts for markets this year. Let's see what the new governor does. But point being that monetary conditions, financial markets are much tighter. The second, and so therefore India needs to, it's like the beauty parade got tougher. So you need to be much more attractive than you used to be. But at the same time, whatever the valuation impact or whatever, I think the RBI is, and the India does have $700 billion of reserves. So a balance of payments issue can get addressed. So there's no emergency medicine needed. On the dollar and on what foreign portfolio investors and why are they selling off? I think there are three reasons. The first is that a large part of holdings in India come through EM funds and Asia funds. And frankly, if you see what's happening in Indonesia, if you see what's happening in, say, Turkey or Argentina or South Africa, the fear that China at some point could potentially go the Russia way where everything gets blocked, EM funds are not seeing that kind of inflows. The second reason is that within the EM funds, India does not look very attractive. And we have to be cognizant of the fact that today it is less about country allocation, more about sector allocation. So if the hottest market and the large market is semiconductors and memory chips and AI and all of that, and India does not have direct plays. So if you want to tell an investor that India's 12-month forward earnings can rise by 14% in the next 12 months, they'll say, well, this can happen in a month. Like the Korean market is up 18% in a month. So therefore, it is not surprising that people within the EM funds are preferring markets where there may be more immediate and faster upgrades to earnings. It may be more temporary. And therefore, we can choose, we can wonder why they would want to hunt for something like that, but it is their choice. And that's what they're doing. Maybe it ends in 6 months. Third factor, which was also self-inflicted, and frankly, we have not fully addressed it yet, is that we had done simultaneous monetary and fiscal tightening in FY25. And some of the effects of that ran well into this fiscal year. It is only now that the fiscal tightening is done as you can see, the fiscal deficit does not need to fall significantly from here. And monetary is starting to ease, though, of course, given all the discussion we had on the liquidity front just a few minutes back, clearly, efficacy of monetary easing, there's a lot of work to be done still. But in that context, at least the earnings downgrades should not happen, and which is positive. So, of the three reasons why FPIs were exiting India, I think the third definitely is starting to get addressed. The second one could be temporary. The first one is slightly more structural. So let's see when that happens. But frankly, in all of this, I don't see what role capital gains taxes have to play.
All right, that's something we heard from Neelkan Mishra about the way of the rupee ahead, and of course, what the factors were leading to the decline. But of course, let's quickly move on to our next guest of the show to about what the budget expectations are from the markets, what the budget has decoded for the markets itself, and of course, the way ahead for the markets itself. But joining me is Nirav Karkera of Fisdom. Nirav, good afternoon. Markets are off to a shaky start this year. Despite today, we saw a good day, but now we have Q3 results, which is almost coming to an end. Budget is done. We have the new Fed chief. What lies ahead for the markets to look ahead to?
So, Lovisha, as you rightly said, it's been quite a day. In fact, quite a weekend with the budget being the way it was. Of course, what we saw yesterday was more of a knee-jerk reaction as investors try and assess what has been done in the budget. We saw markets breathe, with a slightly more relieved sense, right? And on the Fed chair, of course, there's a lot of nervousness. The expectations are of a much more hawkish chair. And that is expected to bear very heavily on emerging markets, and India is going to be no outlier there. We will feel at least second order ripple effects even here back home. The earnings season so far has been quite a mixed bag. In fact, given all the uncertainty around us, we would be in dire need for a much better streak of earnings. So given the way things are right now, there is limited reason to believe that the storm is going to settle anytime soon. Volatility is expected to be the flavor of the season. We are expecting all the asset classes to start behaving in ways unseen, at least over the past 4 to 5 quarters. So that is happening across the board, across asset classes as we speak.
Okay, got it. Nirav, experts that have been saying that the impact of STT hike on the F&O volumes is likely to be limited. But HFT or the high frequency traders, they might shift to low frequency. What is the kind of transition you're expecting here, and of course the impact on liquidity?
So one thing is very clear that HFT strategies, they operate on relatively thin margins, and any sort of increment on transaction costs, which also includes tax like the STT, it will have a meaningful impact, right? So the entire risk reward math really changes with this increment for high frequency traders. Now, it is expected that some of the HFT outfits where the core competency has been on trading on very thin margins and very high frequencies of churn, they may need to reassess their entire business model. The viability needs to be rechecked in the new world order post the increment in STT. So that is one set of impact that will impact a certain cohort of HFT participants. But on the other side, there are also several other HFTs who have the ability to adapt and who may resort to a slower turnover to ensure that margins are still retained to quite some extent while they continue to rake in profitability, but at a slightly slower pace, right? So they need to still reassess their trading strategies. So what will happen in effect is some of the speculative and high frequency noise that was being created in the markets, we can expect that to ebb a little bit going forward. We can expect intraday price discovery to be slightly more stable. It is not going to be significant enough, but with the clearing out of the noise, there could be slightly more stability. So these are some of the after effects that we are expecting, especially in context of HFTs and the impact of STT on their trades.
Okay, got it. But in terms of liquidity, are you expecting any impact over there?
And so the Indian markets have deep structural liquidity. Some of the intraday speculative liquidity may wither away to some extent, but the core structural liquidity remains intact. Indices and stocks have quite a liquidity, and institutional participation, retail participation remains at very healthy levels to offer liquidity. So, as a percentage proportion of this segment participating in the markets, the net impact expected is expected to be slightly marginal, slightly more on the option side, but even lesser on the future side. So net, we believe the systemic liquidity will take much more precedence, and it is enough to absorb the expected trading volumes going forward.
Okay, got it. Nirav, what about the rupee? I mean, it did see a little bit of an appreciation on the back of the rebound in oil prices that we saw. But do you believe that any higher borrowing plan of the government that can constrain the rupee's appreciation going ahead? What does it mean for bond markets also?
So one thing is clear with higher borrowing, there can be some short-term pressure on bond yields as well as the currency, right? However, one thing that we also observed from the budget is that fiscal discipline was maintained, and we are making very good headway and progress on the path of reducing our deficits, right? So we are moving in the right direction. This is supportive for macro stability. There are a few additional levers that are supporting the rupee as we speak. So we have good forex reserves. There is a lot of focus on reviving the entire export segment. In fact, in the budget, there was quite a slew of measures that were announced that is geared towards strengthening our export competitiveness. Small little things like industry-specific, SOPs and things like medical tourism that is being promoted, and several export oriented industry like textile footwear coming back into the spotlight. So that gives some sort of aid. The ongoing set of FTA agreements that we have been signing, it is all only going to add to our strength on the exports front. So a combination of these things are expected to work in favor of rupee, but of course we cannot rule out the ongoing pressure because of the dollar strengthening. So the way we look at life is in the near term, we expect the rupee to be highly volatile. But from a medium to longer term perspective, we believe that structural depreciation risks are largely contained, and it relies on the fact that growth and fiscal credibility remains intact. So in absence of any shocks on those fronts, we believe that the medium to longer term outlook on rupee remains largely range bound, and while in the near term we'll continue to witness a lot of volatility.
Okay. Any range that you're expecting in terms of rupee, in terms of levels front? Because today it has closed up at above 92.5 against the US dollar.
So, like the way things stand today, it is quite a precarious situation, and any sort of prediction is more at the risk of going wrong. But still, just because you asked, and if the stars align the way we are expecting it to, we believe it to settle in the ranges of 90 plus minus one over the medium to longer term.
Okay, all right. Let's talk more about sectors and what the budget actually laid out for them. We'll talk about defense stocks first. We did see that several of them were under pressure today despite the rise in the allocation. But what is keeping the sentiment? Now that the allocation is increased, it could be supportive of inflows, order inflows. But the execution is something that is a key overhang. So how would you address this, and what would your suggestion be to the investors?
In fact, you summarized it pretty well. Defense remains a strong structural story, okay? But we also got to consider the valuation of defense stocks. Right now, more than not, most defense stocks seem to be priced to perfection. It has been baking in the bull case. The expectation is that all the execution will happen in time. There is very little margin of safety as far as valuation is concerned on many defense names, right? So the fact that there is very healthy allocation, there is a macro and administrative focus on indigenization, as a broader theme when it comes to defense. Most of this has already been baked into the price. So right now we stand on the ledge with very limited margin of safety, wherein execution risk in terms of project timelines and ability to defend margins as we progress in time is a big question mark as we move ahead. So we believe that defense right now will witness a shift from being a narrative and story driven theme to being a more stock specific bottom up universe, wherein there are several opportunities, but defense just becomes the starting point and not the entire pack that warrants a buying right now. So bottom up will start being more prevalent when we start approaching defense as a theme, and a lot of focus is going to shift towards not just the size of the order book, but also the quality of the order book, the balance sheet strength that these companies have, the ability to deliver not just upon the entire quantum of order, but also within expected timelines. So cash flows and percolation towards the bottom line is also a key monitorable when we look at defense. So defense is no longer going to be a narrative driven policy level pack that one should seek to buy. A lot of focus is going to be on the bottom up nature of the business.
All right, that is something that we'll be watching out for. But yes, let's talk about infrastructure also. With the kind of capex push we have seen for infra spending, how would you suggest investors to approach the capital goods stocks?
So capital goods and infra are clearly in the limelight. That has been very clearly stated even in the budget. In fact, the capex outlay has also increased. Of course, the jury is still out there. The expectation was that it should have been a whole lot more, but barring everything, there has been an increase in absolute outlay towards public capex, and a lot of it is focused towards infrastructure. We have been introduced to the concept of city economic regions, the CERs, and the improvement in waterways, which is a subject that wasn't much talked about, but from a logistics standpoint and transportation standpoint and trade mobility standpoint, this remains a very key lever. It is heartening to see it find its place in the right at the heart of the budget and their capex push. So also manufacturing remains mainstay. We expect the demand for capital goods and ancillary services to go up in a significant manner. Logistics and energy transition are two other verticals also, wherein there has also been a lot of talk about setting up newer infrastructure, future infrastructure like data centers, etc. A combination of these are only going to add a further tailwind towards demands for capital goods. So, of course, one thing is very clear that it is no longer going to be a question of demand visibility. There's a lot of demand right now also, and on the roadmap as well. But what matters, like when we spoke about defense, which also forms a part of the entire capex outlay, it also spills over here and is replicated here, that the focus is going to be on the execution ability, the ability to defend margins, the balance sheet strengths, and the working capital discipline and capital allocation discipline that companies operating in the segment are going to exercise. So capital goods is clearly a sector that we are positive on, but like with defense, it's not a buy the pack moment for capital goods as well.
Okay, all right. Capital goods is something that you're positive on. But yes, I'll just ask one last question to you, Nirav. Of course, we've seen the gold and silver prices, they've cracked in the past 4 days. Gold is down by about 20%, silver spot prices are down by about 40%. But for an investor who's looking at the ETF space, should they wait for some time before they relook at it? Or what would you suggest to do at this point of time?
So, 2 points. One directly about gold and silver, and talking about the spot prices. The current, decline that we witnessed in the prices can largely be attributed to a couple of factors, ranging right from profit taking to shifting expectations on the global interest rate scenario. Right, a stronger dollar is also adding further as a factor, and we expect some of this volatility to continue in the near term. So gold and silver prices both are expected to be volatile. In fact, between the two, our view remains slightly more in favor of gold from a stability standpoint. Silver in the near term, very volatile, but we expect it to maintain an upside bias in the medium to longer term. However, for both the precious metals, we expect the pace and the velocity to moderate a bit going forward. One word of caution, especially for investors seeking to invest in silver via the ETF route, would be to take a closer look at the ETFs and its behavior versus the spot. When it comes to silver ETF, over the past couple of weeks, we have observed quite a steep divergence versus the spot prices, and this is largely on account of the available liquidity and the float for silver ETFs. Very specifically, so not all silver ETFs are alike. It is imperative that a second level diligence be done while selecting what kind of ETF do you want to participate in. But for taking exposure to the asset class, precious metals at large, we believe that one should not go all in and be very cautious about the entry points, especially on the silver front. The volatility is high. We expect near term to offer several opportunities to buy at lower levels. Gold can be invested into in a staggered manner, but for both of this, the near-term outlook remains in the volatile range, and we expect prices to stabilize further in the medium term. If we have to put a timeline to it, and that's a risky thing right now, given everything is so volatile. But still, one should use 3 to 4 quarters as a starting point before expecting some sort of stable upside bias to kick in a much more reliable fashion.
All right. Diversification is the key then. That's the word on the street, Nirav. But yes, on that note, we have to let you go. But thank you so much for your time and joining us.
Thank you.
All right, that's all we have for this edition of Closing Bell. Definitely, it's a good start for markets today on the day of Monday. There's been no Monday blues despite how we started today. And it's been a marvelous Monday for the markets. We'll get you all the action tomorrow and we'll get back with markets tomorrow itself. But before I let you go, dive into this conversation by my colleague Surabhi Upadhyay. I spoke to market veteran Ramdev Agarwal and talked about whether, despite the STT hike, has it been a good sector-wise budget. So tune into this conversation.
Every aspect of it is taken care of, whether it is fiscal prudence, it is debt to GDP. I mean, all kinds of things have been taken care of. Your consolidation phase in the economy that continues, and there is a lot of prudence in the capex which is being planned. Now, apart from the regular capex, what you get supported, one of the things which is there is the AI led. The data centers, 22 years tax break. I mean, that shows apart from what is the impact, that shows the mindset. If they see opportunity, they can move very quickly and they can move with massive aggression. I don't think any part of the world would give 22 years of tax exemption. At least in India, this is happening for the first time. At least it will open a new avenues, how to respond to the global demand or a demand which is kind of staring at your face, and it could be at the moment you need to in cash. So that shows the ferocity or aggression with which government is coming in. Now, whether there will be a $10 billion investment or $100 billion investment, only time will tell. I mean, that's how the IT boom started. They came to correct their Y2K problem, and here we have a $200 billion or $250 billion export industry, which has changed the story of India itself. So I think this is another leg of a very promising start onto the AI industry participation of India. And in any case, we are ourselves very large, one of the largest user of, I think, 20-25% of the world data is being consumed here, but only 2-3% of that is being housed in India. So we need massive amount of data centers for ourselves, and of course we can be a big supplier of data center services to a lot of countries, not only to US, but many small countries or this entire region. We could be a big supplier of data center and services on top of it, which will come from Bangalore or any other place. So I think it's a big move, and it will lead to a lot of capex. And this capex has like a construction industry. You need cables, you need air conditioning, you need power. You need a lot of lot of actually
Sure.
construction. So I see a lot of plus points there. Just that at the end, this STD thing happened, and that spoiled the mood. But now I think we are recovered and things will be much better.